Hello everyone, and welcome to Tax 1. My name is Tim Samanda, and I will be the facilitator for this course, and I look forward to working with all of you over the next 16 weeks. Taxation, especially at the fundamental level, is not a particularly difficult course. And I say that because taxation is something that all of us are subjected to, especially federal taxation and specifically income taxation, among some others. And we're going to be taking a high-level look at the very basic principles of federal income taxation. So as we begin this course, I'd like to just kind of discuss a little bit about what we won't be covering in this course and some of the tools we will not be using, so that we have a good understanding of the scope of our investigation into federal taxation. For example, we will not be discussing, except by occasional reference, state income taxation, nor will we be discussing in any great depth sales taxes or sales taxation or local taxation. Our purpose in this course, then, will be to discuss federal income taxation as, and I said, a very high-level view, very basic level. Also, we will not be using the Tax Act software that is referenced in the text. So when you see the authors refer to the Tax Act software, you can just overlook that, because using the software at this stage would somewhat undermine the objectives of this tax course, which is to get an understanding of how our tax system works and how it applies to individual taxation and, to a limited extent, small businesses. So that's kind of the scope of our investigation for this term into federal income taxation. Now, when I make these videos, occasionally I'll be using some PowerPoints. Sometimes I'll be using the text. I may be using Excel spreadsheets to demonstrate certain calculations, depending upon the content of the chapter. And we'll be covering one chapter a week throughout the course. Also, I encourage you to ask any questions that you might have as we progress throughout the term. You feel free to email me or join us during the virtual office hours, which are published in BlackBoard. Speaking of BlackBoard, if you have any questions about how to navigate around BlackBoard or how to use it, I know most of you, if not all, have good experience using BlackBoard, but if you have any questions, please let me know. In this chapter, I'm going to be relying mostly upon the text, because it does a good job in explaining what we need to know about federal income taxation and rate structures and Form 1040 and a lot of the concepts that are foundational to our further study of taxation. In terms of completing tax returns, we will be referring to the tax forms as they relate to the various chapters, including this chapter, by the way. But we will not be going through an exercise of filling in the form, again, because that is data entry, and we want to get a good understanding of the tax concepts. But that said, the tax forms are useful in providing instruction and gaining understanding into some of the tax concepts. So we will, as I said, be referring to the tax forms as they relate to the accounting concepts and principles that we are learning. Well, to begin in Chapter 1, which is what we'll be covering today, we know that there are a variety of tax structures and tax systems. And we're going to be talking about the progressive tax system, proportional tax rates, and regressive tax structures, all three of which, by the way, are used at various points in the tax systems in the United States. And we'll talk about them as we move forward. To begin with, though, before we get to actually defining those various rate structures, I have here in Table 1, 2, or the authors do, the individual tax brackets for married persons for 2020. These change occasionally, but they've held constant, the rates have, since the 2017 Tax Act. Specifically, it's called the Tax Cut and Jobs Act. However, on the left, where it says taxable income, those amounts are often indexed to inflation and they are subject to change. But the rates themselves change far less often. And you can see on the far right, under the tax rate scheme, we have tax rates, progressive tax system that ranges from 10% all the way up to 37%, based on taxable income. Now, one of the things that will help our understanding of taxation is to know the terms, at least the basic terms. And that is that taxable income is usually very different from adjusted gross income, which we'll talk about. And adjusted gross income is often very different from gross income. In other words, the money that you earn over the course of a year. So when we look at a table like this in Table 1-2, for example, we want to make sure that we understand what term is being used so that we can understand the context of the information being presented. Taxable income, think of taxable income as the bottom line. That is the amount of income, as the name implies, of course, that gets taxed. You're not taxed generally on your gross income because you get to enjoy standard deduction, for example, or if you itemize, you get to deduct a variety of things, which we'll talk about, to get to taxable income. I'll give you an example of some misconceptions of some of the tax terms. For example, we've heard from the CARES Act and more recent legislation that many of us have received a payment from the federal government, $1,200, for example, under the CARES Act for many individuals, most individuals. And so many people, these are commentators, these are people in the media, will refer to the qualification for earning or receiving the $1,200 check as being your income. If your income is $75,000 or less, you'll get the $1,200, or you would have received the $1,200. And then again, there are other qualifying exceptions to this. However, that is actually incorrect. It isn't your income that determines whether or not you receive the check. Again, the other qualifiers notwithstanding. It's your adjusted gross income. And most of the time when I hear folks talk about this on the radio or on television, they'll use the term income. Your gross income. If you earned $65,000 a year, then you'll get the $1,200, the other issues notwithstanding. And that is not correct. It isn't your income, it is your adjusted gross income. The legislation is very specific about this, and we'll talk about adjusted gross income. So occasionally they're the same, most often they're not the same. So we'll talk about that as we move forward. So the terminology is very important. We mentioned a little earlier the various tax structures, and one is a progressive tax structure. So this occurs when the tax rate goes up, the more money, or more taxable income, I should say, that you have. So as your taxable income goes up, so too do the tax rates that apply to you. And that's what we call the marginal tax rates. So for example, Mary and George are married, file a federal income tax return, and it's a joint return. They're married filing jointly, which is generally the most favorable way to file the taxes for those who are married. And they talk about the tax liability in example 1-1. So if you ask Mary and George, what is your marginal tax rate? They'd say, well, based on our taxable income of $335,000, we're in the 32% tax bracket. But does that mean that all of their income is taxed at 32%? Not at all. While they are in the 32% tax bracket, that's just the last dollars of their taxable income that would be subject to the 32% tax rate, not all of their income. So we use this progressive tax system to say, look, the first $19,750 of your taxable income will be taxed at 10%. In the next level, at 12%, any income between $19,750 and $80,250 will be taxed at 12%. And so forth down the line as we calculate our total tax liability. It isn't just a matter of taking 32% times $335,000, you'd be overtaxed that way. So you go through each of the strata of the progressive tax system, and you apply that marginal tax rate to the income, taxable income that falls within the tax bracket. So what is taxed at 32% for these taxpayers, Mary and George? It would only be the amount between $326,600 and $335,000. Only that amount would be taxed at 32%. And since their income is no higher, then they would not be taxed at any higher marginal rate. It would stop or end here. So then you take the product of the differences in the ranges relative to the taxable income, and you multiply and you add those products together, So you add together the product of the marginal tax rate within each bracket. Marginal tax rate within each bracket, multiply the two together, and then on the far right column you have the results from each strata, or each row, or each marginal tax rate, and then you add them together. And you wind up with, in this case, a tax obligation or liability of $69,231. Well, we're going to talk about a concept then that addresses the issue of whether or not or how much tax this couple is really paying, right? What is their tax rate then? How would you calculate their total tax obligation stated in terms of a percentage? What you would do in this case is you'd calculate the average tax rate. So you would take the $69,231 and you would divide it by their total taxable income of $335,000. And you would have 20.67%. So their average or real tax rate that they finally ended up paying on their taxable income is almost 21%, not quite 21%. And that's their average tax rate. That is their true tax rate, even though they're in the 32% tax bracket. They're in the 32% tax bracket. That's the highest income qualified that reaches that range. All right, so this couple is paying about almost 21% in taxes, 20.67%. That is their average tax rate. So you can see already we have a couple of different ways of looking at tax obligation. As you'll learn, we have tax tables that are available for taxpayers who have taxable income of $100,000 or less, and you can just look up the tax obligation without having to go through these calculations. If the income is more than $100,000, then you'd have to use this method to calculate their tax obligation. This gives a range within the progressive tax system that we have, the federal income taxes, of the number of tax returns that are filed in 2018 at various taxable income ranges. So if we look at the number of returns filed most tax returns in this country were filed under the $50,000 to under $100,000 tax range. And then the next was under $15,000. And then they do give what I think is a very significant and relevant tax burden for these taxpayers, and that is the average tax rate under each of these categories. Remember, this is not the marginal tax rate. This is not based on 12%, 22%. I'll scroll up here. It's not based, the average rate is not generally not going to be the same as the marginal tax rate. Marginal tax rates apply only to each individual strata of the progressive tax system. But the average tax system, as we calculated earlier, is the relevant, the real tax obligation or tax burden that is imposed upon the taxpayer under a progressive tax system. Okay, so again, progressive tax system means that as your taxable income goes up, you will pay more in income taxes. For individuals, that maxes out at 37%. Another tax system is the progressive tax rate structure. The proportional tax rate structure. Proportional, often referred to as a flat tax. It means that we're all going to pay the same tax rate. So, for example, a sales tax. When you go to the store and you go to Target, for example, or if you buy something on Amazon, you'll pay a sales tax that applies to the state in which you reside. That's a flat tax. And, we can argue about and discuss the fairness of a flat tax. Some may argue that a flat tax is fair because we all are taxed at the same rate. Others may say yes, but if you are earning less, then your average tax rate would be higher because you're applying this flat tax rate against a smaller amount of taxable income. Others may say, well, a flat tax rate, like a sales tax, is fair because you have discretion, right? You can either buy the item or not buy the item, so that you can avoid the tax simply by not buying the item. And again, we can discuss the merits of that argument. One might say, well, we would have to exclude certain necessities like food. That cannot be subject to sales tax. In most cases, it's not. But only discretionary items then, like a boat or extra clothes or designer clothes, for example, or things that we don't arguably really need. These things are discretionary, and maybe they should be subject to this flat tax or a sales tax. And again, we can avoid the tax if we simply just don't buy the item. Now, the Medicare tax is another flat tax. It's 1.45% for individuals, and then the employer will match that for a total of 2.9%. There is an additional 0.9% tax for married couples earning more than $250,000, and then the rest, $200,000 for the rest of us. But the Medicare tax is a flat tax. Now, if we're working, we don't have a choice. This is not discretionary. So is the Medicare tax fair? Since if we're working, generally we have to pay this tax. We don't have a choice. This is an employment tax. So even within the realm of flat taxes, we have two different scenarios: a sales tax, and if it's only on discretionary items, we have a little control there about whether or not we pay the tax or not, by virtue, as I said earlier, of whether or not we buy the item. On the Medicare tax side, though, that's a flat tax where, if we're working, we have to pay it. And is that fair that we all have to pay the same tax rate, whether we're earning a little bit of money or a great deal of money, whether our taxable income is high or low? By the way, the Medicare tax, much like the Social Security tax, this is income that's taxed on your gross income. we're going to be focusing mostly on the federal income tax, which is taxed on our taxable income. Our taxable income. But the Medicare tax and the Social Security tax, those are taxed against our gross, that rate is applied against our gross income. So it really calls into question the fairness of the Medicare tax, one could argue. All right, so that's a proportional or a flat tax. Then there is a regressive tax. This is far less common, but it does exist for Social Security taxes. Again, Social Security taxes is based or applied against our gross income. So what does regressive mean? Regressive means that the rate decreases, the tax rate decreases as your tax income increases. How can that be? Well, with the Social Security tax, just like the Medicare tax, which are employment taxes, the Social Security tax is regressive because once the wages, again, it's based on gross income, exceeds $137,700 for the tax year 2020, which, by the way, is our tax year, right? It is now 2021, so we're doing tax returns for 2020. So too with this course. For the entire year of 2021, this course and others will use the 2020 tax year. And so when we look at this regressive tax system for Social Security taxes, we know that those income earners whose gross wages exceed, and that could be salary as well, exceed $137,700, just simply stop paying Social Security. They stop having it withheld from their taxes if they're employed. Or if they're self-employed, they no longer have to send that in. They no longer have to make payments for income exceeding $137,700. So it goes from 6.2% for the employee share down to 0 once income exceeds this threshold. And is that fair? Many would argue it's not, but some would argue, well, it's true that it seems unfair that the high income earners stop paying Social Security taxes. However, a counter argument might be, yes, but if their income is high and they retire, they'll have more of their Social Security benefits taxed. So there are arguments and counter arguments to this. And I don't take a position either way on any of these tax arguments. I only present them as food for thought that will hopefully make learning about taxes a little more interesting. And in fact, the discussion board that you'll be participating in addresses some of these thoughts, these issues and concepts. And they allow you to express your opinion about various tax positions and principles and rules, even some court cases in the tax courts. So those are the three then tax structures: progressive, proportional, and regressive. And some examples. But again, just to reiterate, the Social Security taxes and the Medicare taxes, these are employment taxes, and these apply against your gross income, as I said earlier. All the other income we'll be talking about in this course is your taxable income at the federal level. And those tax rates that I alluded to up here, those tax rates apply against your taxable income. See how these terms are so important. The federal income tax rates apply against your taxable income, and the employment taxes, Medicare and Social Security, they apply against your gross income. In fact, these proceeds, the withholding, for example, goes to two different federal agencies, right? The Social Security Administration will receive the Medicare and Social Security taxes, and then we'll send our payments to Treasury through the IRS for our federal income taxes. So that's the an overview then of the basic tax structures that we have in this country. I went through already this calculation that we call the marginal tax rate. That is the progressive system that we have. The more you earn for taxable income, the greater will be your marginal tax rate. So we have Ben and Martha. Again, they earn $39,175, and they file as a joint return. The first $19,750 will be taxed at 10%. 10% times $19,750 is $1,975. Then you move to the next level that applies to their income. Well, the next level does not exceed the 12% level is greater than their taxable income, so that's where they'll stop. So they'll just take the rest of their income after $19,750, and they'll tax that at 12%. And 12% times the difference between $39,175 and $19,750 from the last range is $2,331, and you'll just add those two together, and then that's their tax liability. I'll give you a minute, if you'd like, to calculate the average tax rate, or the true tax rate for Ben and Martha. I'll give you just a few moments to calculate Ben and Martha's average tax rate. If you had 10.99 or about 11%, you'd be correct. That their average tax rate is about 11%, which is $4,360 divided by their taxable income of $39,175. All right, so that's their marginal tax rate. And this calculation is repeated when we're using marginal tax rates. In this tax system, we use generally a tax formula that becomes a little bit more complex as we move forward, and it relates directly to the tax form, which we'll get to shortly. Just have a brief introduction of the Form 1040. And so we can take from the tax form a formula that will get us to our tax obligation. So, for example, it is conceivable, and in fact, many software programs do this, where they'll use this formula to calculate your tax obligation. So it starts with your gross income, and then you deduct, again, this is the federal income tax, any permitted deductions, and we're going to fill this in later with the various kinds of, perhaps itemized or standard, and you'll arrive at the taxable income. So we're going to expand, we're going to build on this formula as we go forward, but this is the very fundamental, basic formula. And then you apply the tax rates, which we just did. Or we can look, if their taxable income is less than $100,000, we can go right to the tax tables. And we'll demonstrate that later. If not in this video, the next. And you wind up determining your tax liability. That's the amount of taxes that you have to pay. Now, when you do your tax return, Form 1040, that's just a reconciliation process, right? In other words, by the time you do your tax return, if you've had a job over the last year, in 2020 in our case, you would likely have had your employer withhold federal income taxes. And you will compare then the total amount withheld and total amount paid from this calculated tax liability. And if your tax payments, which is your withholding in most cases for most of us, if your tax payments adjusted for your tax credits that may be applied to you, and we'll learn about that in Chapter 9, taken from your tax liability exceeds your tax liability, then you'll get a refund. If your tax liability, however, is greater than the sum of your tax payments and tax credits, then you will have to pay in during this reconciliation process, which we call the tax filing season. So, or more accurately, the tax filing process. And that is fundamentally the tax formula that you'll see used on Form 1040. A couple of things to note here. It's your taxable income, as we said earlier, that gets taxed. It is not generally the amount of your gross income, because we need to adjust that for at least the standard deduction, which we'll talk about. Nowhere does it mention adjusted gross income. That will come a little bit later as we refine and add to and modify this tax formula. We'll add, like I said earlier, a little bit of complexity to this basic tax formula. But this is fundamentally it. Now, in terms of how we execute the tax filing process, we can begin to look now at Form 1040. And we're going to look at the income, which is, you might get a W-2 from your employer, you might have interest income from your investments or a bank. You'll take out any deductions, whether they're standard deduction or itemized, and you'll determine your tax liability by applying your appropriate tax rates to your taxable income. And then any other items related to the federal government. We'll be focusing mostly on taxable income. The question is then, are we all taxed the same? Are we all taxed at the same amount of income? And the answer is no. It depends upon our filing status. Right? So are we single? Are we married, filing a joint return? Are we married, filing a separate return? So we may be married, but we're just going to file our own return. Oftentimes, with few exceptions, and there are some exceptions, but with few exceptions, this is one of the most costly ways for a married couple to file, or for anybody for that matter, to file their income taxes. And we can explore as to why that is as we go forward in the course. Head of household, if you are not married and you have a qualifying dependent or more, one or more dependents, or a qualifying widower, and we'll talk about what that is. Very similar to married filing joint. So the status is important because different rates will apply to the various filing statuses that we're talking about. So, for example, it can be said that a married couple generally, again with few exceptions, generally will benefit most. That is, pay the least amount of taxes by filing a joint return. So I'm going to go down to and by the way, this tax return has been revised. Its principal revisions, it came in 2017 as the Tax Cut and Jobs Act. Quite an overhaul of the tax forms. Years ago, we had a Form 1040A, we had a 1040EZ. Those are all gone now, and we only have the Form 1040, but we have schedules, 3 schedules we've added to 1040 for various types of taxpayers. So many of you are familiar with Form 1040 when you do your taxes or have someone help you with your taxes. And you just fill in the qualifying information, any dependents that you have, the Social Security number, relationship, the qualifying tax credit. So again, this is an interesting area because the tax credits that went up during the Tax Cut and Jobs Act and may be going up again as a result of pending legislation or legislation that is proposed, I guess, at this stage, it's not really pending yet, that the Biden administration would like to enact once that administration takes office. And as of the date of this recording, we are still living under the Trump administration. But so we have not yet had that process of transition yet. But at this stage, the time of this recording, there is a proposal for an additional tax relief, including an addition to the tax credit. So even though we see the form and we might see certain limitations in our text, those are always subject to usually temporary changes based upon some, major macroeconomic event or healthcare event like the COVID-19 issue. And then on line 1, you'll enter your gross income. And we're going to be breaking down each of these line items in the chapters ahead. So we're going to be talking about each of these areas as we move forward in this course. Please note the importance of these sidebars, of these notes to the left margin here, because they're very important in helping us to complete our tax return. Now, it is true most of us use tax software, and unless you're a practitioner preparing people's taxes, you'll likely just answer a series of questions that the software asks you, and then they will populate the form for you. But in this course, we want you to have an understanding of what's going on behind the scenes, right? We want you to have an understanding of how the tax code works and how we're taxed. And that understanding is generally only possible by examining the accounting principles, concepts, and codification, and by looking at the tax forms themselves. So you'll fill in the various amounts, which we'll talk about later. And then again, you can see what's happening as we've just gone through the tax formula. We started with our income. We've taken out added all our income, taken out our deductions, and made some adjustments to income, which we'll talk about later. And then we arrive at our taxable income, and then we are taxed on that taxable income. We're going to apply the tax rates that qualify or that relate to our taxable income. Here's the term adjusted gross income I mentioned earlier. We'll talk more about that later. It's an intermediary calculation. But by the way, as I said earlier, the adjusted gross income, this is the amount that is referenced in the CARES Act and in more recent legislation for when people qualify to receive this payment, this stipend from the federal government. But it's not your wages, it's not your earnings, which is what, like I said, you hear in the media so often. It's your adjusted gross income line item on line 11. That's the amount that the IRS is looking at to see if it's above or below $75,000 for most of us. Depends upon your filing status and things like that. But for a single person, the $75,000. Okay, so that is page 1, and you'll notice that they make references to schedules here. And they'll make references to other forms as you complete your tax return. So in other words, there are other forms that support the main Form 1040. In addition to schedules, the 3 numbered schedules, 1, 2, and 3, there are other schedules. So, for example, if you itemize, you'll complete a Schedule A, and that amount would be transferred over here under your line 12. That amount from Schedule A, if you itemize, gets transferred here. Otherwise, you'll just take the standard deduction, and that would depend upon your filing status. I want to make this, let's see if I can here. All right, if you'll notice on the left, I mentioned how important it was to look at these sidebars here. And your standard deduction, if you do not itemize, will depend upon your filing status. So let me one more time try to move this over here. And you'll notice that if you're single, married filing separately, your standard deduction would be $12,400. So in other words, this is going to reduce the amount that gets taxed. So if you had no other adjustments, you would simply take your gross income and reduce it by $12,400 if you're single or married filing separately. Now, if you're filing jointly, you would double that. And you would take a $24,800 reduction of your income. In other words, this $24,800 of your income does not get taxed. And head of household falls in between there at $18,650. On to page 2 of 1040. Now you're going to calculate your tax. And again, this is just an overview. We're going to be breaking down most of these line items within the chapters, as I said earlier. So this is just an overview, just to kind of get you a little familiar with the flow of the tax forms, not necessarily with how to complete them at this stage. But pursuant to our tax formula, we can now calculate our tax. And for most of us, we might use the tax tables, which we'll get to later. And you continue on, answering any questions, taking any child credits, tax credits that you might qualify for. And again, this is kind of a fluid thing right now, given the legislation, the CARES Act, and other legislation. The other legislation, by the way, would apply to the 2021 tax return, very likely, not to the 2020. 2020, we'd probably look back and see at the CARES Act and take any adjustments to the tax credit provided therein. And then you continue to flow down, just answering the various questions, making adjustments, and then you finally get to your credits. Remember, we said earlier, once you calculate your tax, there may be some credits that you can apply. And credits are good because they're a dollar for dollar reduction in your tax obligation. All right, and then finally, we'll get to the schedules later, so don't worry about any of that. But this is just the flow of the principal tax form, Form 1040. And essentially what we've just done is we've gone through the tax formula. We're going to add in our tax payments from generally our W-2s or other forms of tax payments. And then now it's time to make the comparison. We say, okay, how much do we owe? What is our tax liability? And we're going to compare that to the amount we already paid or had withheld from our wages, as we mentioned in the tax formula that we mentioned earlier. So we'll take our total tax, make any adjustments here that would apply to us, and then we'll finally get the total other payments and credits that would apply, and we'll have our total payments, compare that to the total tax due, and if the payments exceed the tax due, then we'll get a refund. If the payments are less than the total tax, then we'll have to pay in when we file our tax return. And assuming we don't get an extension. Just since we're mentioning this here, if someone files a tax return past April 15th usually, and they get an extension from the IRS to file for an additional 6 months, for example, that extension does not apply to your tax payment. So in the event that you anticipate owing money to the federal government, that is, your payments are less than your tax obligation, then the amount due is due April 15th. That cannot be extended. So someone might say, well, wait a minute, if I cannot complete my tax return, how will I know how much to pay? And the IRS says, make your best estimate, but you must send us a check. You must send us a check by April 15th if you anticipate owing money. And if you don't have the exact amount, make your best estimate of the amount due and send that check. But then you can get an extension on the filing of the tax return once you fill out the proper forms. And then you'd sign it, or you'd sign it and your preparer would sign it if you had something prepared for you. And you've completed your federal income tax return process. So much more to follow about that as we move forward. One of the things you'll notice on the tax form is you'll have taxable interest. Generally, you'll get a 1099 on any interest that you've earned. This is not based on your active earnings or your job, but it's based on investment income. And you are taxed on that as well. And you'll add any other income on lines, and you can refer to the lines above. Any other income that you may have earned from a pension or retirement plans. Any taxable income from Social Security. We know that, we said earlier, some people are taxed on their Social Security. Either 50% or 80% of it is taxed, depends upon their income, at their marginal tax rate. So if you're a person who's a low income earner and they're receiving only Social Security, then they may not pay any tax at all. So not all Social Security is necessarily taxed. But if you're a high income earner, the higher your income as you're receiving Social Security benefits, the more likely it is that you will be taxed on Social Security. Unemployment compensation is taxable. So we know that if someone loses their job, at least temporarily, and they receive unemployment from their employer through the state fund, which is run by the federal government, then this income has to be reported as taxable income. And they'll get a Form 1099-G for that, and we'll go to line 7 in Schedule 1, which we haven't shown the schedules yet, but we will. And go to line 7 and report the unemployment comp. Then on line 12, we talked already about the standard deduction or itemized. We'll dig much deeper into this later. All of this, frankly, we'll get to later. And these are some of the exhibits then for some of the forms that we'll be receiving. This is a W-2. It's a little bit smaller here. And many of us, if not all of us, have received a W-2 if we work for somebody else. And we'll talk more about this later. And then here's a 1099 I mentioned before, and -INT for any interest income that is taxable. So taxable interest, like at a savings account at a bank, would be subject to taxation. Any adjustments to income? Here's that Schedule 1 we mentioned earlier. This is the first schedule. This would apply to a lot of taxpayers. So you have the Form 1040, and it'll refer you or cross-reference you then to Schedule 1. And this will be, for example, any additional income that apply to you. Again, if none of this applies to you, you don't need to worry about Schedule 1. It's simpler then because you don't need to even use Schedule 1. So if you don't have any alimony or maintenance, if you didn't get any refunds, assuming you itemized, and if you don't have business income, you can see any farm or real estate, royalties, partnership, S-Corp, trust, so forth, or Schedule E. So Schedule E would be completed, and then you'd go to Schedule 1, fill in that amount here, and then this total amount gets taken over then to Form 1040. But if none of this applies to you, then you don't need to worry about Schedule 1. Here's some adjustments to income, educator expenses. These are what we'll call 4 AGI expenses. We'll talk about what that means later. These are really important deductions that you can take against your income that will impact the amount of your adjusted gross income. All right, so let me close this. Finally, we get to the calculation of income tax. And again, there's more to this process for taxpayers who have more complexity that would be integrated into their tax calculations, such as owning a business. That greatly impacts the complexity. Or like I said, if you have educator expenses, or you have other sources of income like unemployment compensation. But if, for example, someone just had a job, a part-time job or a full-time job, and that was it, they didn't receive any other income, they were single, for example, then it's very likely they would just use the basic Form 1040 and not have any schedules of any kind. And it would be a very quick process then to fill out Form 1040. So the more complex it becomes, the more likely it is that the taxpayer will use some of those schedules, and we'll talk about those further down the line. I mentioned before that we have, so far, demonstrated the more challenging calculations using the percentage method or the marginal tax rates. However, IRS made it easier by using prepared tax tables that apply for income up to $100,000, and I think I want to qualify what I said earlier. It's up to $100,000, not equal up to an equal. It's up to $100,000. So up to $100,000, we can use the tax tables, and that will give us an estimate of our tax obligation that is close enough, usually within $50 of what we would have to pay, and the IRS accepts this. So then it's just a matter of going to the tables, and we can demonstrate that to look up our tax obligation. We don't need to make mathematical calculations by applying the tax rate in the progressive tax system to each level of income and then adding them together. With the tables, you just go and look up at your taxable income and filing status, and then it'll give you the number. I have in BlackBoard a demonstration of how to use the tax tables, as well as now I already went through the demonstration of how to calculate your tax obligation using the percentage method. But generally, if your taxable income is less than $100,000, please use the tax tables. Now, in terms of the health care tax, we talked a little bit about the Affordable Care Act, or I'd refer to it as the CARE Act. And this would, of course, be new for 2019, end of 2020. And so when we talk about the CARE Act, we have some adjustments to make, and they're, fortunately for us, are built into the tax forms already, but it's worth knowing a little bit about how this legislation, the Affordable Care Act, impacted our health coverage and the amount of our tax obligation. And we'll talk more about that as we move forward, as it relates to the subject matter we'll be discussing in subsequent chapters. There are no additional calculations and no additional tax, though, on 2020 for the amount you may have received under the Health Care Act. So in other words, they're not going to punish you for the benefit that they sent to you. If you received $1,200, for example, last year, then they're not asking you to pay taxes on that. Now, the tax payments, we said, can take many forms. For most of us, it's the withholding on our taxes every time we get a paycheck. And that total amount is sent to us on Form W-2. Others, retirees, for example, or people earning a lot of money, will be making estimated quarterly payments. So in addition to, I'm just going to highlight, see if I can capture the whole amount here. So in addition to having your withholding from having a job, for example, you may be making estimated quarterly payments if your income is pretty high. And that's to say you have a lot of investment income that makes it higher. Or you're retired and you don't have a job, so nobody's withholding anymore. So if you weren't making estimated payments, you'd be receiving all your pension checks and whatever other retirement income you're receiving, but nobody's withholding taxes on that, or maybe withholding taxes on that. And so, come tax time when you do your reconciliation, completing your tax return, you may find a huge tax obligation with possibly penalties and interest. So the federal government requires those folks to make these quarterly estimated tax payments, so that when they file their tax return, they don't have this big tax bill to pay. We'll talk about credits in Chapter 9, but I want to emphasize the Earned Income Tax Credit. This is for low-income earners, and it's really important that if, this would apply to anyone that you might know, that they make sure to take this credit if they qualify for it. Because this is one of the few refunds that can be generated even if there's no income. In most cases, you need to have income to get a refund, and then you may only get a partial refund depending upon the tax credit. So the Earned Income Credit is one of the very few credits where you can either have low income or potentially no income and still qualify to get a refund generated by the Earned Income Credit. And we'll talk more about that, as I said, in Chapter 9, but it is worth calling this one out because this one is somewhat underutilized by low-income taxpayers, and they don't want to miss out on this credit if they qualify for it. The myriad of other tax credits we'll talk about, those that relate to tuition, for example, for students, and many others. We're going to talk much more about those in Chapter 9, like the lifetime learning credit for tuition, for example, and many others. And then finally, you'll add up all of your payments, your withholdings, and any estimated payments you made, and then apply the credits. Because what's nice about a credit, as I said earlier, is a credit is a dollar-for-dollar reduction in your tax obligation. And some credits can generate refunds, or at least partial refunds. So essentially you're saying, look, you're going to take your tax obligation based on the tax table, for example, and you'll say, okay, I owe this much to the government. I owe $5,000 to the federal government. Now you'll look at your tax credits, and you'll take your tax credits away from that. And then you'll take any payments you made away from that. And if you have a negative number, you'll get a refund. That is to say, you paid in more than your tax obligation. If you get a positive number, that is to say, your tax liability is greater than all of your payments and credits, then you'll write a check to Treasury for the amount of deficiency. The shoebox of software, I mentioned that earlier. This refers to your tax software, which we are not using, so you can kind of go right past this. We won't be covering the appendix in this chapter, but if you have an interest in tax authority, and that's to say what rules we have to follow, the tax code, that would be the statutory. Administrative would be any regulations that have been drafted by the IRS that we need to follow. And then judicial, any case law that applies to taxes. And talk a little bit about the history of the United States taxation system, kind of interesting for some of us. So if you have an interest in Appendix A, feel free to go through that. Also, please review all of or most of the PowerPoints. It's another nice way to reiterate what I talked about. Like I said, I will often use PowerPoints in my lectures. In this case, though, this chapter was excellent for supporting a discussion, a lecture with you. So that in this particular chapter, I used the text. In some cases, I might use both. I might use both PowerPoint and the text in the chapter. All right, and the assignment then in Connect just kind of reiterates a lot of what we talked about here in this chapter. Feel free to contact me if you find you have any questions.